Hi guys, it's Zhang again with Moolahwise.com, and today I just wanted to make this quick video about what we call the X curve. This concept is what we call the X curve, and basically this concept just shows the relationship of responsibility over here on the gray line versus your wealth curve, and the way it works is like this. So let's say this line right here, the x-axis is your age or your lifeline. So over here on the left, you're younger. Over here on the right is you're more older. And then the y-axis is your money. Okay, so the first line is the gray line. Again, I'll explain each line more in depth as I go through this presentation. But the gray line just represents your responsibility. So when you're younger, you have a lot of responsibility, and this line decreases, right? And then, but at the same time, you will also start to build your wealth, right? When you start to build your wealth, then you save and invest and allow your money to compound. And when it compounds, then it will grow for you. So that's what is depicted by the green line. So as you age, your assets and your money starts to compound and starts to grow. So the rule of the X curve is that what on the left side, you're more less secure because you have high responsibility and you have little money. But on the right side, you should be more secure because your responsibility is going down and you also have start to have more money. But again, I'm going to explain each line separately so that way it is more clear in your head. So the first line is what we call the responsibility line, right? So in this picture, the responsibility curve is going down. So it starts off high, but it's going down. Think of this is depicted by this picture. So let's say you're a young family like my wife and I, right? My wife and I, we have me, my wife, that's me, and then that's my wife. We both, so we have a house, right? And we have cars, but we also have two kids that we gotta pay for their college education. So if you see, basically all these responsibility is on my wife and I. And sometimes this responsibility could be in the millions, right? And if you don't have $1 million lying around, if you suddenly go to heaven, or if I suddenly get hurt and I can't work, then all these responsibility is still on me. So what I always tell my clients is if you have high responsibility and low wealth, right, then you could transfer the responsibility or the risk, right, to an insurance company, right, to an insurance company for your loved ones, just in case if something happens to you and you go to heaven suddenly, at least your family won't be financially unstable. At least your family will still could go on financially without you. So yeah, so understand that this is just a line that goes down. Um, so it just goes down. So the part that you just got to remember is that this responsibility goes down, and think of this picture as me and my wife carrying all these responsibilities, all these burdens on our shoulders, right? I didn't draw it very well, but it's just a cartoon depicting my wife, and all these burdens are still on my wife and I. And even if we die, we're still on the hook for all these responsibility. Right. So let's get into the next curve, which is the money curve, right? So again, so let's say as you march through life and get older, your money starts to compound and you start to be better with your investment. And once you better with your investment, then your money grows, right? So let's say on the right side, let's say still you and your wife, right? Right. Uh, let's say you let's say you still have the house and the cars and you still um so let's say that whoops let's say that as you go through life, you paid off your house, right? You paid off the cars, you paid off the kids. I mean, just kidding. You paid off their college education. You would still have four holes. We like to call them holes or stop sign to prevent you from acquiring more wealth. And the first stop sign or the first hole is called inflation. Second hole is what we call market risk. right? And then the third hole is what we call taxes. And then the fourth hole is what we have is health, right? So imagine if you've already paid off your house, your cars, the kids, you would still have inflation to deal with, market risk. There still may be market risk in where you're putting your money. There's still, you have to account for your taxes on once you have any kind of growth or any kind of capital gains. And then you still have to account for your health. But let's say you had a plan in place where you neutralize your inflation, your market risk, your taxes, and your health. Guess what? You would still have what we call fixed costs, and this fixed cost is something that you would still have for the rest of your life, meaning you would still have a cell phone, you and your wife would still have gasoline to pay for a car, you guys would still have groceries excuse me, groceries to eat, right? And so that's what we call is fixed cost. But what if I showed you a saving vehicle that can neutralize all five of these risks? And I'll explain each of them below. What if I told you that the index universal life, or IUL, can neutralize the inflation, can neutralize your market risk, can neutralize any taxes, can neutralize your health risk, and also your fixed costs. So let's get into it. So the first risk is what we call is inflation. So the first one is called inflation. And inflation just means the buying power on your money. Okay, so every year it goes down. So let's say if today you had $100, next year you really only have 97 because you lose about 3% per year due to inflation. 3% per year. But this year in 2022, the typical inflation we're seeing about is like 7 to 8% because of all that money we printed, the US government printed in last year during lockdown, during COVID. So this is the typical inflation rate that we see, but this is we're seeing it this year because of all the money we printed, like I mentioned. So this is because of COVID, but usually we're in this range. So the IUL, the index universal life, right? I'm just going to write IUL for easy purposes. You can gain 0.75% all the way up to 13%. So if you take the average of that, you're somewhere between 6.7%, or so let's just round up and let's just call it about 7%. Okay, so average rate of return on the IUL is about 7%. So I always tell my clients that you have to put your money somewhere where it outpaces inflation. Again, guys, typically we usually see about 3%, but because we're in this weird time where we had to print a lot of money, and when I say we, I mean the US government had to print a lot of money because a lot of people were struggling during COVID. So I like to tell people that wherever you put your money, make sure that it outpaces inflation. So as you can see, the average, and again, average is not a good way of dictating where, what am I trying to say? So the average, as you can see, the average IUL rate of return can beat the inflation. So that first one is check. Second risk is what we call market risk. All right, so the second one is what we call market risk. And in the IUL, right, there is a zero market risk. Why? Simply because it has what we call a floor and a cap. So a floor means that if the market that you're invested in, or the market that it's mirroring, goes below a certain amount, you get capped off at 0.75%. And again, guys, I'm only using the Transamerica number because I'm a licensed and appointed agent with Transamerica. So I'm just using the FFIUO Transamerica number, or the IUL from Transamerica. So you can get up to 13% if you invest in the S&P. So we're just going to keep the S&P for this example. And again, guys, your money in an IUL, your money is not actually in the market. It's just the insurance company credits you based on how the index is doing. So if the index goes up, you go up with it. But let's depict how it looks like when with floor and cap. Okay, so I'm gonna draw over here. So let's say in a typical in a typical in a typical investment vehicle where there is no market and there's no floor and cap. So think of it like this. Okay, so let's say in a stock, in a typical stock, right? Your money puts in, you can go up, you could also go down, you could also go up, you could also go down, right? But in a floor and cap, when you have a floor and cap, your money is safe. So let me show you. So over here, so let's say your money starts at the same place as the red line, right? Well, when it goes up like that. And then when it's about to go down, instead of going negative, it will go even. And then when the market starts to climb back up, you don't have to come from down here. Okay, you're actually from up here. So you will actually have higher gains. And same thing. So when your money goes down again, you're actually up here, right? So remember, the beauty of the floor and cap is that you don't have to make up this distance. Okay, and when you have to spend time making up this distance, you can never predict what the market is going to do. So this vehicle actually just you just mirror an index. So, and the index on this that I'm referencing is the S&P 500. So you're just mirroring an index. So meaning when the market goes up, you go up, showing in the green line. But when the market goes down, you go even. Your money is safe, or 0.75%. The green line is the floor and cap line. Okay, so this is depicted by the floor and cap. The green line is the floor and cap. So if I were to ask you, Mr. Client, where would you want to put your money? In the red line, where it could go up or down at any moment, or would you rather have a steady growth up? Okay, so I don't know about you, but I'd rather put my money in the green line. So it helps you neutralize this risk. So that gets a big check mark. Next is the next risk that we want to talk about is inflation. So no, I'm sorry. The next risk is what we call as taxes. Sorry, I already talked about inflation. The next risk is what we call taxes. So I always ask my clients, like, do you think the taxes are going to go up, stay the same, or go down? And people always tell me, oh, like when I go to work and I retire, I'm going to be in the lower tax bracket. But if you look at it historically, right, the tax rate, the highest tax rates during World War II was about 90%. And at those brackets, even the lowest tax brackets even will still be higher than what it is today. So a couple of things I want to point out is, when we always have this conversation about the taxes, is the U.S. debt, right, is $23 trillion. $23 trillion debt. This is their debt. This is the debt that they owe other countries, owe people. Is $23 trillion. Okay, so in the U.S. government, their way of making money is taxes, and that's the only way they make money, is taxes. And so being in money, the formula, if you want to reduce your debt, is either make more money or spend less and save more. Okay, so if what's more likely from a U.S. government, to make more money or save more and spend less? Okay. If it's make more money, then they have to raise their taxes. Like I mentioned, taxes is the only way they make money. The U.S. government, anyway, is by raising taxes. And so and also in this conversation, I would point to the 3 buckets of taxes. And so I just kind of reiterate it real quickly, why this vehicle is tax free. Okay, so the first. So let's say the first bucket is what we call the tax now. And in this bucket, we have stuff like stocks, mutual funds, and then over here we have bank savings, and checking. And then we also have real estate. So everything in this bucket, when you make any kind of gains, Uncle Sam gets a piece, and the bigger the gain, the bigger the piece that goes to Uncle Sam. And yeah, and there's other ways you could roll your real estate into other properties, but I'm just speaking as a conceptual level. Like you still have to pay property tax, you still have to pay any kind of capital gains in this bucket. The next bucket is what we call and I'm not going to go too in depth in it. I have made other videos about the 3 buckets of taxes, so I would just tell you to refer to that. But I just wanted to kind of bring this back to kind of remind you why this is tax free. So in here you have like 401k, you have your retirements, your IRAs, right, and your pension, your annuities, right? And then over here in the last bucket, in this bucket, in the tax later, you don't get taxed now, but you will pay tax the year you retire. And I like I always tell my clients, like, Mr. Client, do you know what your tax rate's going to be the year you retire? And if the answer is no, then doesn't it make sense for you to at least buy taxes when they are on sale, like today, when you know the rate? So the last bucket, right? The last bucket is what we call tax never. And in this bucket, you have like stuff like the Roth 401k / IRA. I'm just grouping them together because it's for to me it means the same. It's just a retirement account, but the Roth version. You also have something like the 529 7702 or IUL. So this is why this is tax free, because it's basically, it is an insurance product, but you, as long as you save money inside of an insurance product, you can get it tax free, simply because the U.S. government can't make us buy life insurance for our responsibilities, right? But they can incentivize us to buy life insurance, and the incentives they give us is tax breaks. So anything inside of a permanent life insurance or will be able to take advantage of the 7702 program. And 7702 also covers like whole life, universal life, variable universal life, and index universal life. But today, we're only talking about IUL, so index universal life, and excuse me, and that we believe that everyone should have one of these. But reach out to us at info@moolahwise.com for your accurate number, so that way we can take your number and run an analysis on what you may qualify and what you can afford. Okay, so the fourth risk is what we call the fourth risk, right, is what we call long-term care. Right, so the fourth one is health, right? I'm sorry, health. And why is health so important is because, as you age, you get weaker, and if you get weaker, then you're higher likely to fall into a health scare that where you're going to get this money from, right? And let's say you, and I'm sure you're probably thinking, yeah, but I probably have Medicare or some kind of healthcare program. Won't they cover long-term care? And the answer is no, it does not cover long-term care. So what I'm specifically talking about is long-term care. Why is this scary? Is because long-term care, 70% of us going to need some kind of long-term care before we die. So which means 7 out of 10 people that you know and meet will need some kind of long-term care. And why is this important? So long-term care in California right now costs, and again, this year 2022, costs about $8,500. So long-term care just means like skilled nursing facility. There's different levels of long-term care. So it could mean skilled nursing facility. It could mean adult daycare. It could mean private skilled facilities, or even in-home care. And it costs about $12,500 per month. This is the figure that we find in Google. This is from California today. So let's say long-term care, right? Let's say you don't even have to be old to get long-term care. Let's say you go skiing and you break both of your arms and break both your legs, right? You can't eat, can't feed yourself, can't bathe. There's a way to qualify for long-term care, but let's just say you broke both your arms and broke both your legs, and you can't eat, you can't feed yourself, you can't bathe. Yes, you will have, if you have health insurance, the health insurance will bandage you up, send you home, make sure you're alive, and that's what we call short-term care. But let's say after you've broken your arms and legs, you still need some kind of income until you get back on your feet. Here in the IUL, if you qualify, right, you could take 2% of your long-term care your face value, right? So let's say to pay for long-term care per month. And again, guys, since it is an insurance product, this is tax free. So let's say you own 500,000, which is a typical amount. I'm not saying that this is a typical amount that we see in California. Your face value might be different depending on what you qualify for and what you can afford. So reach out to us, and I'm just using this as an example. Okay, so let's say you own 500,000 life insurance, right? You would get $10,000 per month to help you pay for long-term care per month. And again, this is tax free. Right. And then the next thing, you could use this life insurance. So basically what I'm saying is that you could use your life insurance before you die. You could use the money inside your life insurance before you die. And then the next thing I want to talk about is what we call terminal illness. So if you are terminally ill, the insurance company can advance you up to 75%. Again, remember, guys, this is Transamerica IUL, so I'm just using the Transamerica's parameters. But we're a broker dealer, so we could also represent, other insurance companies like Nationwide, Prudential, and Pacific Life. They also all sell IULs, but I'm just using Transamerica because it's easier to remember. But that doesn't mean I can't represent them. Okay, so just keep that in mind. So you take 75% of your face value. So let's say you have 500,000, so you could take 75% of 500,000 before you die. They would advance you this before you die, and then the last 25% goes to your family when you do die. So again, this product, this one vehicle, can also help you with your health when your health insurance doesn't cover. Okay, so I know I kind of went kind of fast on the long-term care, but check out my other videos about long-term care and terminal illness. Okay, so you basically use your life insurance money before you die. So think about that. And then the last, even if you neutralize all those risks, right? The last risk is what we call the fixed costs. Okay, so let's say even fixed costs. Whoops. So let's say fixed costs. So you during retirement, you're still going to have a need for gas because you might still have a car. You might still need money for groceries. You might still need money for a cell phone. And if you're not working and your retirement benefits is not sufficient, then where else are you going to get that money? But guess what? You can get that money from here. Like I mentioned, you could get a tax-free distribution, but there are some terms that you have to apply to. So in this IUL program, the first 10 years, so year 1 to year 10, you have to pay 0.75% to access this money. But after year 11, you can access your money 0%. Granted, there's enough cash value in there so that your program doesn't lapse. And I always get this question of, hey, why do I always have to pay for my own? Why do I have to pay for my own money, right? But if this money was inside of a Roth or 401k, you would have other limits on top of the penalty. You would have an age limit. So let's say a Roth, right? You would have to have the money in there for 5 years and be 59 and a half, or you pay 10%, or you pay 10%. Right. And I always ask my clients, like, okay, yes, you have to pay for your own money, but if it was in a Roth, would you rather pay 10% or 0.75%? Right. And same thing with a 401k, right? Let's say 401k is the same thing, right? But you would still have to apply to the age limit, right? So you would still have to be age 59 and a half to access your money or lose 10% penalty. And I always ask my clients, like, okay, so Mr. Client, what happens if you need this money before age 59 and a half? Where are you going to get this money? In the IUL, right? There's no age limit. There's no age limit. You just have to pay 0.75. It's just, think of this as a fee that they're charging you for from year 1 to year 10. And you can use, once you pay the fee, you could use it for anything. Okay. So as you can see, this neutralizes the fixed costs. So I just want to reiterate what this one savings program can do. Okay. So it also could neutralize your taxes. So to go back to this picture, right? So one program I could show you, I showed you below, it could neutralize your inflation risk. It could neutralize your market risk. It can neutralize your taxes. It can also neutralize your health. And guess what? It also could neutralize your fixed costs if after you've already paid all that off. So the last, this is my last slide, is I want you to um, so again, guys, this is just what we call the X curve. It just shows your law decreasing responsibility over time, and versus your law, the graph of accumulating wealth and how it grows over time. So I want to ask you, where are you currently on this graph? Okay, so I want you to ask yourself, where are you currently on this graph? Are you on the left side where you have a lot of responsibility and not that much money? And if so, then reach out to us and let us set you up with an IUL. Or are you in the middle where you have your own plan and your responsibilities are decreasing and your money is starting to grow? Or are you on the right side where you don't have responsibility anymore, but you also have money coming in? So, and you're more secure. So, again, guys, it's Zhang from Moolahwise.com. And if you like what you see, please like and share our channel, because we have a mission of educating 1 million families on how money works, because this stuff was simply never taught to us. And it's my fiduciary responsibility to educate people so that way people can understand money and help make better money, make money decisions. Thanks for listening, guys. Learn more at moolahwise.com. Again, that's moolahwise.com. And my name is Zhang, and I'm just trying to help our mission of educating 1 million families in the USA. So if you know anybody that will find benefit in having a conversation with me, please introduce me and reach out to us at info@moolahwise.com. Thanks for listening. Bye.